We are about to get started. Let me just get some things ready. Um, okay. Oh, that's not what I want to do. No, sorry. Yes, it is. Spotlight for everyone. Can everybody see my screen clearly? Okay, great. All right, so as we get started here today, it's really important for everyone to understand not just real estate itself, but understanding the macroeconomics market cycle where we are, so that you can invest with confidence. And I'm going to teach you things that I don't think anybody out there is teaching. And so, just to kind of give it a little bit of a background, I got into real estate in 2011 when I bought my first. Before I even start there, I got into real estate before right after the crash. So of the '07-'08 crash, I got it in 2011, which means everything that I did in real estate was a win, right? I mean, from 2010 onwards, all the way to 2020, you couldn't make a mistake in real estate. And so there were so many gurus. Everybody was a real estate guru. I thought I was a real estate guru. And there were so many mistakes that I made, but the market itself saved me because appreciation was just constantly happening. I would over budget my new builds by double and still make money. So during that time, we started to lose the fundamentals, and no one really cared about understanding what actually moved the economy and what are these indicators. So people didn't really care too much about that. It was just about real estate was always going to make money. So today, from 2021 onwards all the way to 2025, we've seen a huge a bear run, really a crash in the commercial real estate space, in our economy, because the Federal Reserve has really just tightened the amount of money that they allow into the market. So they took a lot of money out. So I'm going to share with you guys all of that. I don't think anybody out there is really teaching this. It took a lot of research in the last year and a half for me to fully understand all of this myself. And I'm still a student, but I have become a little kind of like a nerd around all this data and really trying to understand what it all means. So I will do my best to share my experience, my knowledge, and from there, I hope that you guys use your own critical thinking to make an educated decision as what you want to do in today's market, right? How do you take advantage of this? In a great market, I just heard this weekend that in a really great market, there were people that made a lot of money and there were people that lost a lot of money. In the down market, there's going to be a lot of people that are going to make a lot of money and a lot of people that are going to lose a lot of money. That's just the nature of it. Now, as the market was coming up, right, we all felt that hype and everybody wanted to invest in real estate. There was also a lot of people saying, man, I will invest when the market comes back, when prices come down a little bit. Well, guess what? The market has corrected and prices have come down. And the same people that were emotionally investing or wanting to invest in real estate are now saying, oh my God, the real estate market is crashing. It's bad to go into it. And they're listening advice from, people that really had no business giving advice. And so that was happening all around, right? And so today we're in a correction. That means if we zoomed out and looked at real estate and look at just investment as in general, when the market comes down, when things come down as a discount, you want to buy at these times, right? So you don't want to get caught up in what the media is saying, what everyone's saying. You want to cut through all of that. And that's the whole point of today's call here is let's cut through all the noise. Let's cut through all the headlines and media to really understand what's going on so that we can make these decisions ourselves. So I'm going to introduce, I'm going to start my slide here. I want to just get right into it. My main vehicle of creating financial freedom is through real estate. And so the webinar is titled Building Wealth Through Real Estate, but we got to understand a lot more than that, right? So first, before we even get into anything else, I just want to share the free resources that we have in our community. So Monday night calls, we do another one similar to this. It's more like an introduction to it. Thursday calls, we dive a lot deeper. And these calls are great for you to just invite your friends and other people that perhaps may want to get into real estate with you. If they're asking you questions of how to invest, is it a good time? Instead of having to, talk to each person that way, invite them to these calls, get educated together, understand the market, get confident, make these decisions together, and invest in real estate together. Okay, or whatever else you want to invest into. But when you understand the macroeconomics of everything, it makes decision making not based out of what we're hearing or what our emotions are or what everyone's feeling. We really just look at the key metrics and the indicators. And so let's invest from that place, right? And that's going to give you confidence. Confidence is going to come from the knowledge that you have, and that's where confidence is going to come. So hold on one sec here. All right. So, we also have a WhatsApp group. It's a great community. It's all free members. So you do have to do your due diligence in there. We're not really vetting a lot of people. Now, obviously, if somebody is being toxic in the environment, we will remove them from this group. But most of the people are really there to help and want to create partnerships and do collaborations together. We also have a Facebook page, free school community with lots of resources. So if you scan this QR code, you'll get a link to any of these things. So this is just part of our free community resource that we offer to everyone. So on today's agenda, we're going to talk about the market shifts so that you can move with logic and not fear. We're going to understand commercial real estate a little bit. You're going to understand it based on just where we are in the market. And my intention is that you leave with more confidence, more clarity. And the bonus thing that we're going to talk about here is there going to be an AI bubble, right? AI is what is driving our entire economy right now. So I'm going to talk about that a little bit. I'm going to show you guys a little video that I was watching this morning, which is what really, had me want to have this conversation. So I would love for you guys, when we get to that point, to also share what you guys are thinking about it. Okay. And so I want to start today with, this is a chart that I made. I really pretty proud of this chart. It's a market cycle, and I added emotions on top of like what happens during each one of the cycles. So in real estate and really any investment, even in stock markets, Bitcoins, all of that, there are 4 cycles that happens during that time. So let's just look at first emotionally how people experience on an upcycle. So when I told you I got into real estate around 2010, and from 2010 to 2011, from 2011 to 2020, basically there was just, we came right out of the 07, 08, and we started to feel this like hope. There was bailouts that was happening. Real estate became really affordable, and a lot of people took advantage of it. So there was hope, there was relief, and then there was optimism, right? Because a lot of people were making 2x, 3x. I made 11x on my first purchase in 2.5 years. 11x. $40,000 investment turned into $440,000 in equity. So you can see that there was a lot of optimism during that time, and then excitement. Everybody wanted to get in, and everyone was making money, and people were asking, what do I buy next? What do I buy next? And there's just so much hope, like it's never going to end, right? There's this feeling of, these good times are never going to end. But like all cycles and all of life, there is the ups and there's the downs, there's the ebb and the flow that happens. So what happened in 2021 was there was a huge 2022, the U.S. Federal Reserve, not the U.S., but the Federal Reserve basically decided that inflation was too out of control and they need to take money out of the market. And so we started to see interest rate increases, and there was anxiety that was happening where people were like, no, they can't keep this going. There's no way that they're going to increase rates. And they did it 11 times. So people were in denial, and then real estate prices came crashing down. BlackRock was losing office buildings and brand new Class A buildings. People that were in the middle of building new construction was really afraid because they're like, oh my God, interest rates are too high and I don't know how we're going to get out. So then there's fear, desperation. These are the things that are the emotions that happen during this up and down. And, at the point that there is really hopelessness is there's the maximum financial opportunity. So when there's a lot of uncertainty, when people are afraid, this is when the best investors are going to take advantage. Okay, they're getting ready to take this bull run again. So that's the emotional part of it. But when we talk about real estate, what happens during the crash, when things crash, nobody's going to start building, right? So you have buildings that are finishing and they're leasing up and they're giving all types of concessions that hurts all the competitive market, and everybody is hurt, struggling, right, to just fill up occupancy. And there's a lot of empty units that get to be absorbed. So no more new construction. So during this phase when it's recovering, there's no new construction happening. But as everyone's making money again, people get back into the game and start building again. Boom, boom, boom. They start building, and so on goes the cycle. Now I made this this horizontal line and this vertical line. The horizontal line is the line of buyer market and seller market. So when you are below this line, it is considered a buyer's market. In a buyer's market, you're able to negotiate the best prices, you're able to negotiate the best terms, and there are more sellers than there are buyers. So sellers have to be the one that gives in, and the buyers are in a position to be able to negotiate the best amount of deals, to put the least amount of down payment down, do a lot of creative financing. And opposite of that is above this line where there are way more buyers than there are sellers. I remember when I put a property on the market and there was 4 people bidding for it and it ended up selling for $50,000 more. I was like, wow, that's crazy. So that was constantly happening, right? So that's called the seller's market. Sellers basically put their deal up and there's so many buyers, they don't have to make any concessions. As a matter of fact, they actually get to choose who they want as their buyer. And so that's a seller's market. And so just understanding that a buyer's market, the market works for you. During the seller's market, it works against you as a buyer. There's fierce competition in the market to buy good deals. So, some of the deals that would be available to you in a buyer's market is not going to be available to you in a seller's market. All right. So just want you guys to really understand that. And so this is a chart just, for all of you guys, understand that everything moves in cycles, and real estate, we are no different. We are currently going through, you decide, what do you think the cycle is in right now? 2025, November 13th, 2025. Where are we? Right? Like, what is the emotional experience that collectively in our society we are experiencing around real estate? What is happening to deals? When you go out and look for deals, is there a lot more buyers or is there a lot more sellers? So we're going to answer some of those questions in the following slides. But first, I also want to educate you guys on the macroeconomics. I'm really excited about all this because people don't understand this and nobody really is even teaching it. All right, so you have to go and dig and learn and watch. I watched hundreds of videos and read hundreds of articles just to fully really grasp what is going on. I looked at the history of things. And so, yeah, I'm going to share all of that with you in this one webinar. So it all starts really with the Federal Reserve. Okay. Yeah. Oh, next slide. Okay. What is the Federal Reserve? First of all, the Federal Reserve is not, I probably should get my face out of the way somewhere here, but I don't know how. Whatever. The Federal Reserve is not a U.S. government entity. Okay, they're not part of the government. They're actually no one really knows who owns them or what, but they have a mandate. Their partnership with the U.S. government is that they have 2 things that they have to keep track. One is inflation, which is the pricing stability of our market, and then the other one is employment. Their job is to maximize employment and to control the rising of prices, which really is inflation. So when inflation is too high, the Federal Reserve basically has this lever. Okay, when inflation feels like it's too high, they increase their rates, and then they tighten up the money that goes out into the market, the availability of money circulating. They pull this lever and they stop the flow, and that slows down the economy. And when employment is too high because people can't get business loans, and they have to let go of employees. When that gets too high, the Federal Reserve changes their lever the other way and say, okay, we're not too worried about inflation right now. It's under control. We're going to put more money back into the market. Businesses have access to capital, and hence they can hire more people. Same thing with the government. As the government get access to more money, they can hire more people. So it's this control thing, right? I mean, and this is the debate all the time. Do we actually need the Federal Reserve to do that, or can the free market actually just keep our economy stabilized? No one really knows the answer to that. There's good arguments for both, but anyways, they exist, and they're probably not going to go anywhere because let's call them, they're the central bank for the United States, and central banks basically monitor. They operate everywhere around the country. All Western countries have a central bank, and you can actually see that a lot of the countries that don't have central banks, it's a lot more volatile, and they go, there's you'll see those around, but mainly the central banks control how money flows. So the other thing that we got to really understand is this thing called federal fund rates, which is when, people are literally like, oh, the Federal Reserve cut rates. That means interest rates must be lower. That means, homes are going to be more affordable. Well, that's not exactly the case. When they lower the federal fund rates, all they're doing is lowering the overnight rates between how banks borrow money from each other and how the bank borrows money from the Federal Reserve, the price of that. So typically when that is lower, then that means they can offer lending lower as well. They can lower the rates, but it only influences it because there are other things that impact it as well. Our mortgage interest rates consist of two numbers. Number one is what is the 10-year Treasury. So 10-year Treasury is an IOU note from the government. So it's considered the safest investment you can make because the U.S. government is not going to go bankrupt. As many people want to say so, it is a big ass country. It's a big country, and it's not going anywhere. Okay, the U.S. government is definitely not going anywhere. So an IOU from the government is the safest thing. The Treasury bonds, these bills, they have short-term ones, they have 5-year ones, 10-year ones, 30-year ones, and typically mortgages follow the 10-year because that's the average life of somebody owning a mortgage. So even if you have a 30-year mortgage, typically people will refinance out of that within 10 years. And then when you look at commercial real estate, they're much shorter, 3 years, 7 year, 10 years. So they picked the 10-year Treasury as the marker for that. So that's one aspect of a mortgage rate. And the other one is how much is the difference that the banks are going to charge, right? So right now, I think the 10-year Treasury is right around 4, a little bit below 4. So if we're just like, oh, then that means interest rates should be around 3.75 or 4%, right? No, because the bank's going to add their spread for taking the risk of lending you the money. Now, how do they determine that spread is also how much the Federal Reserve, how much does it cost them to borrow money from the Federal Reserve, and how much mortgage-backed securities the Federal Reserve buys. So here again, these are the oh my God. Sorry, my mouse is out of control. Okay. So they buy U.S. Treasury and mortgage-backed securities. These are the two things that they buy. Of course, their biggest investment is in the U.S. Treasury and mortgage-backed securities as number two. These are the two main things. I'm going to go to the right picture first, which is how Treasury prices are related in terms of the yield. So sometimes people are like, oh, wait, what does that mean when people are buying the 10-year treasury? When people are buying the 10-year treasury, because more people are buying on a supply and demand, the price of the treasury goes up, okay, which means the returns on that same money lowers. Right? So I have an example in here. Let's just say that you get $20 on $1,000 treasury bond. Okay, so it gives you a 2% yield. But if enough people and enough investors and the Federal Reserve is willing to buy the 10-year treasury, then the price goes up and your yield drops. So the yield itself is what is going to determine how expensive mortgages are. And so understanding like just the relationship of that, right? So if nobody is buying the 10-year treasury, then the price has to come down and your yield goes up. And if the yield goes up, that means interest rates will rise with it. The other thing to really understand is, there's a lot of talks of quantitative easing and quantitative tightening. What does that even all mean? They always use these like language that is hard for the average person to understand. And when people don't understand it, they're just like, I don't know, whatever, right? So I remember hearing something from Jerome Powell that he said something like the downward pressure of unemployment is rising. The downward pressure of unemployment is rising. It's like, dude, why don't you just say that unemployment is rising? And that you are trying to, you're trying to put a downward pressure on it. And it's just very confusing the way they say things. So cutting through that, you look at what is quantitative easing and quantitative tightening, and why do they even have to use these words? So we're just going to say QE and QT. Okay, QE basically is when the Federal Reserve says, okay, the gates are open, money can flood back into the market. And quantitative tightening is when they say, nope, they pull that lever and they close the gates. No more money is going out. We want to get paid back all the things that we purchased. So 10-year treasuries being paid back by the government, mortgage-backed securities being paid back by people that have mortgages. So they're like, okay, money comes back, but nothing's going to come back out. And we all know that the US and basically majority of the Western world lives off of debt. And so when there's no more money that's in flow, the banks are challenged. They're pressured. The government is pressured. This is why Trump was pushing for all of this. And it's funny because Trump actually put Jerome Powell in place, and then Jerome Powell did the opposite of what Trump wanted him to do during the Biden administration. So, some of these things matter. I don't know what their personal relationships and those things are, but again, just cutting through all of that and being able to listen to the news, understanding the key metrics around all of this. So what happens when they do quantitative easing is when the Fed says, okay, we're going to buy more treasuries so that more money flows to the government. We're going to buy more mortgage-backed securities so more money flows to the bank so that they can take more money and go and lend back out. When they lend back out, businesses are able to get a loan. They can hire more people. They can, do whatever it is that businesses need to do to grow. They're not in this like cutting cost phase. So typically when more money floods into the market, what happens is inflation, right? Inflation means the value of your dollar goes down. And if the value of your dollar goes down, that means that things go up in price, right? So eggs, milk, everything. I mean, nowadays you can't order any food. I was looking at just prices of like Chinese restaurants. Right? I remember when I was in college, it was like for $9.99 I could get a meal. Now when I look to go and eat somewhere, it's like $29.99. So prices go when inflation goes up, prices of things just go up, which also includes your real estate, your stocks. Like these things are all inflated. It goes up. Now, when they're like, oh, well, that's too much inflation, we need to stop it, then it corrects. So there's a correction that happens. And then that's when they do quantitative tightening. So the reverse is happening, and just understanding this is very important, especially when we look at the next chart, because the next chart is literally the Federal Reserve balance sheet. Yeah, a slice of pizza. It's totally right. We just went out and ate a couple slices of pizza. It was like $56. Um, so when you look at this is the Federal Reserve um, balance sheet. That means how much money does the Federal Reserve have out in the market? All right. So in 2008, 2009, they did when this graph goes up, it means they're doing quantitative easing. That means money is flooding into the market. So they went from 1 trillion to a little over 2.2 trillion, something like that. And inflation. There was, remember during 07, 08, how reckless was our economy? The loans that were being handed out because there's just so much money. People didn't know what to do with it. They created things that just was not sustainable. And if we just follow this chart, just following this chart can guide us in understanding where the market's going to go. Because maybe it was, maybe it was a little bit, it may take time. Everything lags a little bit. So when they release all the money, there's a lag time between the crisis and all that, because that money needs to be spent. So as you see the financial crisis, they decided that they're going to tighten. They're going to go, whoa, too much money is in the market. We need to take it out. And that was when the financial crisis was happening at its max. It was like right around 09. People lost hundreds of millions of dollars of real estate. I know people that lost $50 million, entire portfolios just being lost. And people went from being very, very wealthy to bankrupt, like almost like overnight during that time. So that was just like this little dip, right? And so the coming back of it, when we think about, well, let's look at the 4 seasons of the real estate market cycle too. So let's just look between 2000, let's just say 2011 to 2021, 2022, where, I experienced a complete bull run. So money is being put back into the market for a pretty long period of time. From 2010 onwards, I was making money in every single deal. Every time money was put into the market, into our economy, there was an increase in value of hard assets. So real estate was just appreciating constantly because there's so much money being flooded into the market, right? And so from 2010 to 2014, almost double the amount of money, from 2 trillion to 4 trillion. And then it went up to 4.5 trillion. And, during all these times, it flattened out. So we don't know how long it's going to flatten out for. But flatten out is good because it's predictable. We know what to do in the market, especially if you know how to fix a property, add value to the property, refinance it, sell it, whatever your strategy was. It's very predictable market, and people were able to make money. Now, around 2019, 2018, you started to see it come down a little bit. This is when quantitative tightening was starting to happen. The Federal Reserve was putting less money out or even reinvesting back into the market. That's when we saw, let's just think about where is that turning point, right? So as the economy was like facing potential recession, COVID hits, right? This whole COVID thing. And COVID should have actually drove the economy further down. But instead, the Federal Reserve decides that we're going to interfere with the market, and we can't have people be depressed and not working at home and all these things happening. We need to just inject a whole ton of money into the market. So, and when this says repo market blowout, this is the repo is where banks borrow money from the Federal Reserve. So basically, at this point, banks have very, very low liquidity, and there was a lot of challenges here for a lot of banks. So they're like, nope, that's not the time. They inject money. Look how fast they injected money and how much, right? So from 2019 onwards, this was very, very, if I knew this back then, this is basically a big indication of the market's going to blow out, right? I mean, we can just see it in history. This is exactly what happens. And so from 2020 to 2022, real estate was out of control. I know that there was things in Miami, like rents. People were getting kicked out, like their leases were up, and they would literally double the rents from $2,000 to $4,000 because money came flooding in so fast. And the people that had access to money was buying recklessly. And it's not really their fault, because it just seemed like it was going to continue rising, right? And so from 2020, let's just call it the bottom of this, close to 2020, up to 2022, from under $4 trillion to $9 trillion. That's how much money was put out into the market. So what do you think is going to happen? Inflation must be so out of control at this time. And part of the federal mandate is that they need to keep prices under control. During this time, it was super out of control. So they're like, okay, now it's time. People made enough money, 2022. If you bought any real estate in 2022, right now it is definitely lower in value. And so is a lot of things. So we have this crash that came down. They took $9 trillion down to $6.6 trillion. So what is that? Almost $2.3 trillion out of the market within these years. It's such a long crash, and people are like, it must come back. It must come back. So in 2025, here we are. Economy's out of control. Everybody's uncertain about everything. There's still risk of inflation, right? But they say inflation's more in control. But this whole downward push, just this year alone, 2025, 1 million jobs were lost. 1 million. And they're still planning to cut way more. Okay, 1 million jobs was lost. So they're like, okay, it's time to flip the lever. The focus is on quantitative easing now. The tightening is over. So what happens during easing? Prices go back up. Money is being put back into the market, whether it's through the U.S. government or mortgage-backed securities, allowing the flow to come back. Prices are going to come down. Interest rates should come down, right? We will see. But technically, they should. But when interest rates are down, what happens, like around right here, when it's recovering? Prices are going to go back up, right? Money is going to come back into the market. Prices are going to go up. So we're in this pretty unique period. Maybe this will flatten out for a little bit, but the Federal Reserve has said that the quantitative tightening is over. They have to put money back into the market. The unemployment, the workforce is really struggling. And money's going to become cheaper because it's going to become available. It's going to come back in. Who knows how high they're going to put their balance sheet? Maybe it's going to go to 10 trillion, 11 trillion, whatever it is. But trust me, during that time, you want to just be riding the market up. So you really just think about, when do you want to be purchasing, right? If you looked at across this chart, when do you want to purchase? Yeah, I want to purchase right here when it's down and ride it up. I want to purchase right here when it's down, ride it up. I want to purchase right here, right? The people that bought from 2019 to 2020, when there was this potential risk of COVID and all of that, people got really scared. And there were people made so much money in real estate during this time because of that. All right, now here it comes down again. So, for yourself, just understanding history, understanding the charts, understanding how all of this relates, you can decide what to purchase. Now, still have great fundamentals in underwriting deals. Cash flow is going to be king. Knowing what your expenses are, if you can lock it out for the next 5 years during this time of uncertainty, that lowers your risk. And then really quick, understanding why people had so much problems was because from 2010 onwards, if you got something called adjustable rates. Adjustable rates is it moves with the market, and typically they allow you to have a higher leverage. Their interest rates just move with the market, and there's no prepayment penalties. So if you're buying a fix and flip, or if you're doing a BRRRR, or if you're buying an apartment building that you're doing a value add and take money out, you don't want to be locked in, because if you get like an institutional or a government-backed debt, they call it perm debt, agency debt, then there is heavy consequences for refinancing or selling early, right? You're typically charged a lot of money. It's called prepayment penalty. So you don't want to do that. Why would you give 100,000, 200,000, a million, 2 million to the bank for that? So most people for 10 years, basically adjustable rates were great. It actually went down, right? When we were buying properties with adjustable rates during 2014 onwards, by the time that we were exiting, interest rates were actually a little bit lower than when we came in. Like, amazing. Who would have thought something crazy could possibly happen up here where they took such a huge increase? So during this time, interest rates went to basically zero. I mean, the 10-year treasury went to zero. People had interest rates and loans that were mortgage loans that were like 2.5, 3%, right? 3.5%. I mean, if you locked it in during that time, none of this stuff happening affects you much at all, except for the fact that you can't sell it right now. Because what are you going to do? You have a property at 3.5% interest rates, means you must have overpaid compared to the market today, because your $2,000 can afford a $600,000 property, but today the same $2,000 can only afford you a $200,000 property, right? So that means someone else cannot come in and buy your property, and even if they do, you can't go out and repurchase a property. So all of this is affecting the market, all right? The other thing to really consider is supply and demand. Even though this is a little bit old, but this is actually a little bit worse now in some places and different somewhere else. But this red line here represents the amount of buyers, and the blue line represents the amount of sellers. So 2020 onwards, right? I said this is a seller's market. There's so many more buyers than sellers. During this time, everybody was overpaying for real estate. Today, when we flip it around, there are less buyers than there are sellers. So we are now in a buyer's market, buyer's demand. And when we go back to this chart here, where is the buyer's market? Buyer's market is below this line. All right, so this is more indicators of where we are in the market cycle. Now, this is a cool thing that I found. It was just, I found a chart of how many sellers and buyers there are. And even though this is residential, but it still reflects the market itself. So Miami, Florida, having almost 3 times the amount of sellers than there are buyers. Florida, Texas, Arizona, Vegas, these are markets that were hit pretty much the hardest right now, and they're buyers markets. You can negotiate really great deals. And then there are balanced markets like Washington, D.C. There's about the same. And it's more, when you notice this, it's more like the northern properties, the states that are in the north typically are, more balanced, because everyone was moving from north to south to the Sun Belt. Majority of these ones that you see in the buyer's market, these were hit the hardest by the correction, because everyone was moving there for a period of time, and then they thought it was going to keep happening. So more houses were built, apartments were constructed, and now people can't move. People can't sell their houses, and so people can't move, people can't buy, and we have this lock. This is a lock between sellers and buyers, and there's just way more inventory in these markets. So if you look at wherever you're investing, where do you want to be investing, right? This is anytime when you're in a buyer's market, you have the advantage. Balanced markets are just balanced markets. They're great. You can still make a lot of money there. But here is the seller's markets. There's still seller's markets, right? These are really strong markets where, they weren't really affected. A lot of people actually moved out of those areas. Into, like you see, New York, New Jersey. A lot of people moved from Maryland, from these northeast states down south, and right now they're actually experiencing anything they put on the market, they're actually still able to sell. There's still multiple buyers. So it's still a seller's market in these areas. So you're not going to get the best deals in these areas, right? I mean, there are so many. Newark, New Jersey. This is where I bought my first property, actually, and I went to college here. I can't believe it's listed on here. There are way more buyers than there are sellers. I have a friend, actually, that is probably buying all the properties in New York, in Newark right now. If you look him up, David Choi, he's got a big wholesale company and lending company up there, right, based out of Newark, New Jersey, and they're buying thousands of properties a year. So this number probably he influences this number a lot, and mainly in Newark too, Newark, New Jersey. So really cool. Hopefully, like what I'm sharing right now is like opening some like aha moments for you and creating more clarity. We're gonna open up for question here shortly, but actually maybe we'll just open it up right now for a couple seconds before we transition to the other side of our market with AI. Does anybody have any thoughts, questions, comments about anything I've shared so far? Feel free to either raise your hand or just unmute yourself. You know, I want to whatever you need, right? Utilize this time to get more clarity, to educate. And there are no dumb questions.
Alex, I was just going to make a comment in regards that, the easing and adding of money into the economy, kind of, if you think of it like blood in your body,
Right.
it's the same thing. You get too much in it, you're going to blow a blood vessel. And the way that government has to manage it is just like your doctor has to manage yours. And so, this is kind of what you attribute to what's going on. When you really have those major spikes like that, your heart is really pumping hard. And that's a big issue, because eventually you keep doing that, you're going to crash. And that's kind of where we're seeing in some parts of the market. I know that in the commercial end and multifamily end, you're seeing some of these deals are really happening. In most residential, it's down maybe 15%, but in commercial, it's down 15 to 35, 40%, depending on, the kind of deal you're looking at based on the current loan that they have and their motivation to sell. And
Yeah.
so,
Exactly. I mean, we recently saw a $50 million deal go for $10 million. I mean, it's
that's a
insane.
seller's market. That's not a seller's market. That's a buyer's market.
That's a buyer's market. The seller is in such desperation. Not only the seller is in desperation, the lender of that property is in such desperation. Right? So as
Right.
a
They don't
buyer,
want
imagine you can actually negotiate with banks. Like, when does that happen? We
very fairly.
must be in a really great time to purchase. And, I don't know if we're at bottom or not, but based on just looking at this chart, right? And what I've shared with you guys and what has been going on, like, where are we in this chart? And if we're anywhere below this line, great. All right. And then when we talk about AI here in a second, we're not going to take a whole lot of time, but I'm going to share a couple things with you guys. You guys will see that we are potentially at the point of maximum financial opportunity right now.
It's getting that way.
Yeah.
And I used to be an REO broker for banks, and I did that in the early 90s, and then again in the late 90s, and then the millennium bug and all that. And I can tell you, and 2008 as well. But there's a point where the banks are looking at this exact information that you're presenting today. And by the way, congratulations. This is right on, spot on in regards to the way the banks look at it.
Mm-hmm.
They go, okay, hey, look, we're on the downside of, this line here, and we're not going to allow any new construction loans.
Yeah.
You start seeing them, all of a sudden you see nothing being built. And we're seeing that some because they realize, hey, we've looked out in our crystal ball and we can't do that deal. And same with, you're going to start seeing REOs coming back. You're seeing lots of notice of defaults out there right now because
Yeah.
people are not making their payment. And so those are in the increase by like 30% right now,
Yeah.
just in the last 6 months.
And if you think about it, like from the bank's perspective, right, from a lender's perspective, when it's down here, sometimes they're just going to cut their losses, right? Let's just look at that $50 billion deal going for 10 million. They're cutting their losses. They took the property back at 30 million. They're taking a $20 million loss. But you know what? The lenders get to now have a new loan for this $10 million, even if it's $8 million. At least it's a performing note, right? and they want to just build that back up. They know the market's going to come back. That cycle's going to get to a point where they're going to have access to money, and they just need to cut their losses right now. And whoever is going to take advantage of the losses that the banks and current operators and owners are going to incur, who's that going to be? Right? If we think back to 2007, 2008, there were apartments, there were condos in Florida and Miami area and Fort Lauderdale going for $20,000 a pop. And people weren't buying them, right? Because there was so much panic and so much hopelessness. People were not buying them. They were so focused on all the noise versus just the fundamentals. Like, how much lower can you possibly get in an apartment for $20,000? You can't go and build another one for 20 grand, right? And now those apartments are worth $500,000. Think about it. For 20 grand, you put $5,000 down. Even if you bought it cash, if you put $5,000 down and that 5,000 turns into 500 grand, that's 100x on your money. That was the opportunity that people were just so focused on, the emotions and the news and all that versus fundamentals. There were mansions going for $100,000. Some of them people were getting for like free, right? 100 grand, 150 grand, and now they're like 5 million. Same thing is happening today. I mean, even though the numbers are higher, it's like, oh man, this apartment's going for, $50,000. Well, they're not going to stay there, right? This is what this today, our economy and our market cycle is providing for us. So if you knew then what you know now, and we're like, okay, here's an opportunity. We had the crystal ball. We lived into 2025. Now let's move back, and it's 2007, 2008 all over again. And here it comes, this big crash, right? You're like, I know exactly what's about to happen, right? I know exactly what's about to happen. What would you do to change the direction, the trajectory of your entire life now with the knowledge, with a crystal ball? Now I'm not saying what I'm providing here is a crystal ball, but it's indicators, right? You at least give yourself a chance, and everything points to the same place. Right? Even if the market crashes a little bit more, you're still in the good fundamentals, good underwriting, focusing on cash flow, some fixed expenses and stuff like that. Rates, great. Even if it goes down a little bit more, it's going to come back up. If you knew then what you know now, like, what would you do? How many condos would you purchase? Right? Knowing that they could be 100x. Right?
As many as you could.
I would go. It's $5 grand. Let's say it's $5 grand to purchase each one. And you're like, I only got $100 in my bank account. Are you just going to sit on the sideline? You know that they're going to be worth 500 grand later.
Yep.
Right? You wouldn't. You would do whatever you can to get in the game and buy as many of those as you can. You will find the money.
You might have to make some payments till they get occupied, or
Right.
some of them were even occupied. But think about it. If you're paying 20 grand for something that's worth $500,000, what the banks don't want to do is they don't want that on their books, and they don't want those HOA fees on their books, because the banks will have to be paying those HOA fees.
Yeah.
And, they don't want to do that. I can tell you, we foreclosed on many a deal and had to pay millions of dollars in HOA fees that were outstanding because, the banks got to pay it.
Yeah.
They're a big name, and the government's helping them out. They got to bail it out. Well, guess what? Our tax dollars paid for those HOAs, and they still got whole again.
Yeah.
And so one thing I was going to say about the $10 million deal for $50 million, and they had a loan for 30, over a period of 30 years, that loan's going to pay them $35 million.
Yeah, exactly.
And so in reality, they made whole by selling it for 10.
Mm-hmm.
If you think about that, they hold that deal for the 30 years, they got their money back and some.
I mean, they're not going to hold it for 30 years. They're going to roll it right back and package it up, sell it back to the Fed, and they're just going to do this over and over again. They'll make their money back on the ride back up. They know that. But there is pressure now today, right? I mean, we're going to have to suffer a little bit so that we, can enjoy the fruits later on. But if you think about it, is rents going to come in 10 years, are rents going to be higher then, or is it going to be higher now? Right? Just think about that. And if that's the case, is real estate going to be higher then, or is it going to be higher now? And if you can just logically think about this, then you know what you should be doing, and you can do it with confidence. So that's the real estate sector. I want to just spend a little bit of time talking about AI, because AI is what's driving our economy right now. Okay, AI is driving our economy. Remember, let's look at this chart. Seasons of investment. Even the AI conversation, where are we right now? What's the overall experience around AI? What can I buy next?
Optimism.
Yeah.
I think it's optimism right now.
It could be optimism. There's a lot of excitement. There's probably a lot of things, but whatever it is, I mean, we're not going to guess where it is. This is why I want to just have an open conversation about this, right? And, but I do feel there is, I don't know exactly where we are, right? In terms of that, but let's look at some stuff that is showing up that I want to just share with you guys. So right now, the top weighted company in the S&P 500, NVIDIA is number one. That means most people, if you're invested into the index fund, a huge chunk of your money is with NVIDIA right now. Microsoft, Apple, this is Google, Amazon. This is the top 5 companies hold about 30%, and they're all in tech and they're all in AI right now. Okay, this is heavily invested into AI, and I just want to, and even the higher ones here, but I want to just share. I want to share a video real quick. It's short, just a couple parts of it. Let me see if I need to. Let me go back to this. I'm going to share my screen and sound. This one. And can everybody see this? Okay. So I'm going to play this.
NVIDIA by itself gets almost 8% of every dollar. Now, that's gotten investors very excited about the future of how AI is going to, change our lives. And it's also why their stock values have gone way up this year. And they've been able to spend a lot of money because of it. In 2025, those AI tech companies are going to spend roughly $330 billion to build things like data centers, GPU farms, and all the stuff that they need for AI. But here's the part that's interesting. In order for AI companies to justify their valuations, in other words, what the price of their stock is today, those companies would need to make around $2 trillion a year in revenue. $2 trillion. To put that into perspective, in 2024, Apple, Amazon, Microsoft, Meta, NVIDIA, Google combined did not make $2 trillion. In other words, AI has already been priced as if it's going to become the biggest money-making engine in the history of capitalism, bigger than every major tech company today combined. That's kind of a major red flag.
So that's the first thing I saw. I mean, it's pretty interesting, right? I mean, this is how, when we saw the real estate cap rates being so low, people were purchasing future value. So today, the value of, NVIDIA and, the AI tech and all of that is already priced at $2 trillion. They need to have $2 trillion to justify the valuation today, which they're nowhere near. And they're saying that, it's going to be greater than all the top tech companies combined, which is, a little bit like, he says a little bit of a red flag, which is interesting. The second part that I want to just fast forward to is just talking about what a bubble is.
Well, come for the finance and stay for the AI bubble. Now, I know it sounds a little silly, but what is a bubble?
It was the worst day on Wall Street since the crash of 1987.
Most people say it's when the price of something goes above a sustainable value because of hype and greed. But what a bubble really is when the price of something goes up really fast with no relationship to its fundamentals. It's when nothing changes, but the price still goes up really fast. So let me explain the mechanics of how this AI machine is actually working, and then you can decide for yourself if it's a bubble. So in the AI economy, money or revenue is created through what's called circular financing. Now this can get confusing, so let me just show you this graph, which as of right now is slightly outdated, but you'll get the idea of what's happening. So at the center of this is the most valuable company in the world, NVIDIA. It's worth trillions and trillions of dollars because it's a way for the world to bet on the future of AI. So NVIDIA decides to invest into OpenAI, the people behind ChatGPT. So they're like, here's $100 billion, go build stuff. OpenAI is like, cool, we got $100 billion. So it then commits to huge cloud contracts with other companies like Oracle and Microsoft to run their models. Well, then Oracle and Microsoft are like, wow, look at all this demand that we have for our services. We're making money, right? Oracle then takes that demand and buys tens of billions of dollars of NVIDIA GPUs. NVIDIA's like, we're making money. And then NVIDIA agrees to invest more of that money back into OpenAI. So the money goes from NVIDIA to OpenAI, from OpenAI to Oracle, and then from Oracle right back to NVIDIA. It's the I owe you skit from the Three Stooges.
And speaking of money, how about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10 and I owe you 10.
Thanks. Hey, Mo, you owe me 20. Well, here's 10 and I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you. Here's the 10 I owe you.
Good, now we're all even.
It's a
Super interesting. I really love that analogy. So I just wanted to share that and, and kind of have an open conversation about what that, what you guys think about it too. Wait, and one more thing I want to share actually is, before we get to that, is this. Does anybody know what this chart is? Can anyone guess what this is a chart of? Okay, this is a chart. Okay, go ahead, Jeff. You wanted to guess?
It says trust, something trust Bloomberg. So it's got to be the way the value, I'm thinking it's the value of a stock.
So this is the percentage of Berkshire Hathaway's, Warren Buffett's cash holding compares to everything else. So remember, so let's just look at this chart real quick. 07, 08, this area of crash. Somehow Warren Buffett decides he needs to up all of his cash, right? And then, and then Berkshire Hathaway just becomes the wealthiest company in the world after that, right? After the crash, and buys everything. Well, here we are in the front end of something interesting again, right? Warren Buffett sold another 981 million shares of Bank of America recently. Now Warren Buffett has $278 billion in cash. Why is it that when there is so much hype right now in the market for AI and everybody's like, oh my God, we got to invest back into it, right? That Warren Buffett would say, I'm going to take all the cash out of it.
Why it's 180-degree theory.
Yeah. So
you go this way, I'm going that way.
Yeah, exactly. So there's just, because there's like what the video was sharing, for me personally, I feel like, yes, perhaps there is so much increase in the valuation without the fundamentals, right? Warren Buffett is a really fundamental person. The earnings itself does not justify the price of the value of these companies, which everybody is also, when your 401ks and IRAs are invested into the index funds, and trust me, if they're with Vanguard or whatever, they are in there. You are part of that investment. So will there be a crash? I don't know. But, it seems like there's indicators pointing to that. And if I was a betting person, I would take my money out just at least to sit and wait, right? During these times of crazy hype, during the times of
irrational exuberance.
Yeah, like all this is happening where it's okay to take the money out anywhere around here to sit and wait. Right? Because we know something's going to have to give. And when something gives, that's the time to buy. I guarantee if Warren Buffett is still alive in the next year or 2 years or whatever, they are going to acquire so many different things. We were at Jeff and I were at an event this past week, and the guy that started Series, what is it, aircraft? Series Jet. They bought an airline for $100,000 during the 07-08 crash. $100,000 they bought an airline. So, like, Warren Buffett is going to be buying many of those types of things that are extremely discounted like that, sitting on $300 billion, and he's still exiting. He's exiting anybody that is invested into AI tech like that.
Yeah.
And so if Warren Buffett's doing it, it makes me just wonder a little bit more of where we are. And understanding market cycles, again, is confidently, like, understanding market cycle is about managing your risk. So anybody putting money in right now, because there's no fundamentals to support all the evaluation. And it was interesting, this guy Andre share that circular financing, right? Where NVIDIA is, wherever they're getting the money from, perhaps it's a big loan first, goes to OpenAI, goes to Amazon, goes to Oracle comes back, buys from NVIDIA, and what's the fundamentals in there, right? I mean, if you think about that. I mean, I do think ChatGPT is not going anywhere, but we also once upon a time thought Blockbuster was never going to go anywhere, right? So these big companies can crash very quickly, especially in technology, when something comes in and just completely interrupts the market. There's risk in that. So, and, you know, Jeff and I were talking about this too. The data centers, how many people are building data centers right now? Technology, you're buying real estate based on technology. You know, technology grows really fast. Once upon a time, a flat screen TV was like $8,000. Now you can get one for like $200. So if you build a data center, you know, with the highest tech, with NVIDIA's newest GPUs, what are those GPUs going to be worth 10 years, 15 years down the road, right? I don't really know. I mean, it's for me, it feels like there is a bubble that is coming, and that's just my opinion. Okay, I don't got a crystal ball, but based on all of my nerding out of this stuff, I can look at real estate with a lot of confidence. I can, if I was a betting person in the stock market and in our economy, I would also be like, let me bring my cash out and put it into something that is going to, where is the bottom of the market? I'm looking for a buyer's market. I'm not looking to be at the top of the market cycle playing around. I'm looking to see where the bottom is. And so things move in different cycles, right? Real estate right now may be at its bottom and it can come back up. You can ride that up. But as real estate gets to that point again, you know, it would, in 2021, 2022, it was probably a good idea to take it out of real estate and put it into something that was also at, you know, towards the bottom of the market. There was probably Tesla and some of these companies had some downward swings that might have been a good time to buy dips. So if I was just playing like that, like if this was a video game, that's what I would be doing. I would just constantly be finding where the buyer's market is in whatever industry. And I think that's the game that Warren Buffett's playing. Berkshire Hathaway is literally a massive real estate company as well. And so he's just bouncing back and forth between what he can buy. I'm going to buy this company when it's down. I'm going to sell it when it's up. I'm going to buy real estate when it's down. I'm going to sell it when it's up. And I want to play Warren Buffett's game. But things are so close to our face that sometimes we can't look at this macro scale. And this is why I don't think anybody's teaching this. I don't know one person that is teaching or sharing this. And so I want to get this out to as many people as possible so that we can start this conversation, so that I can become more educated as well. You know, I know there are going to be people that analyze and nerd out so much more and can feed me back this information. And at least now we have an overall context of how to analyze and critically think about our economy, right? When news comes into our face, we can actually decipher whether this is something that we should act on or what is behind the veil. if we can see through the veil of these things, it's going to make us much more dangerous investors. Dangerous. Maybe that's not a good word for that, but better investors.
I would say
Smarter.
accurate.
Yeah.
I would say accurate investors.
Exactly.
2008, I was building a house that was 11,000 square foot, and the market fell out, and I was in sticks. The foundation had been built, everything was built, and I thought, oh my God, am I okay? We need to take these down, and this gig is up for at least a period of time.
Yeah.
And then my mentor at the time said, hey, Jeff, the money's in the bank. They're not pulling your loan. Your cash flow is going. That's not going anywhere. And if it does, in 6 months to 12 months, that will be back. And in 12 months, I came back. I lost 7 figures in a short minute. And it was like, and I was being managed by a stock guy, supposedly a stock guy, that was doing it. I had millions in the market, but then all of a sudden I lost $1 million. And I'm telling you, 2009, I think it was March of 2009, it all came back. I had maybe added 100,000 or 200,000 or something like that. I took every dime out of the market and I paid off 27 houses. And I said, screw the market. I'm making my own cash flow, my own deal, and, F the banks. And that's exactly what I did.
Yeah.
And I said, absolutely, this is the only way to make sure that I'm going to be here in another 25 years, which I'm here, and I'm still doing it. And my point is that we have to be very cautious about what's going on in the market. Today, the market went down 800 points on the Dow. NVIDIA is sucking wind. Microsoft is sucking wind. And they're talking about Venezuela and all the stuff that's going on down in the market there. I mean, I can tell you, those are all things, but really think about it. The Dow's at like 48,000 or isn't it like 45,000? I remember when the Dow was 15,000. And I mean, if it crashed again tomorrow, and I pray that it does, because guess what? It's gonna be on. It's
gonna be on.
It's gonna be on because 2008, I sold a guy that bought took everything out of his American Airlines portfolio. $1 million. We bought a HUD property, and it was an office building in HEB, Hershey Bedford. It was a 22-story building he bought for $1 million.
Jeez.
That thing is worth $35 million today, maybe $40 million today, and it's occupied. And so my point is, you really have to study this as a critical thinking matter. This is one of those things where details matter, and I'm kind of that. I kind of nerd out on that a little bit, but details matter in this scenario, and you better talk to everybody you think. And not everybody you listen to is going to be the right guy, because, and you have to filter that out. You have to say, okay, I don't want, no offense, but I might say, Tanya, hey, that's great information, but that's not for me. Or, Sue or Anna, they might have some really cool information, and they say, that's cool, but that's like a shiny object thing. I'm not interested in that, And that's kind of what Warren is doing. He's like, hey, I know this works. If it doesn't cash flow, it's out. Any other question? No. And I'm going to be safe when the market falls to hell.
Yeah.
And I'm going to be good because the cash flow is coming. Cash flow is still happening. And people are still eating at his Dairy Queens and, drinking his Coca-Colas and whatever else he's got.
Yeah.
But the point is, it's not going to get replaced by AI.
Yeah.
A lot of it.
It's so funny because I remember, I don't know where I saw it, but I remember Warren Buffett, or I read it somewhere, that says, never run out of cash. That's the king, right? They just never run out of cash. So in any sort of uncertainty, right? If you're an investor, it's about de-risking. You don't need to take unnecessary risks. There are many, many things that you can do that is very low risk and can create great returns. So you just got to move around the market where it becomes inflated. Get out of it. Don't be the person to hold the bag, right? That's what they call it. You hold the bag if you go in at high and somebody else exits. When Warren Buffett took $300 billion, or 300, what is it? 300 billion? Whatever. Yeah, $300 billion out of the market. That's $300 billion of money that is somebody's holding the bag because he's out. He's out. That means you're in. All right. Whoever came in later. And this is what, this is our institution. And hopefully with this, like, we're expanding, the perspectives that you have so that you can be more discerning about what's going on. And this can be, we can macro this out all the way to the global level, but we don't really need to right now. Let's just look at the fundamentals of the United States, right? And then and you can bring it back down to look at the fundamentals of a single deal. You can look at the fundamentals of a single company. But when you understand the macro, it helps you understand the risk that you're taking when you zoom in on a smaller deal. Like when you know where you are in the market, okay, I can buy this deal. Even if it's a little bit risky, I know the market is at a certain point that it's going to come back and help me, right? I can take that risk. Now you can't take that risk when you're buying at the high. When you're buying at the high, you have all the risk in the world of downside. You can't make a single mistake, right? Even if you did great, you perhaps can still lose money. So knowing where the market is, hopefully this was super supportive for everyone. I want to just share one more thing here. We have 2 events coming up that I just want to invite everybody to. And so the event is December 20th. We're going to do a 1-day virtual 4-hour workshop on creating the blueprint, like taking what we learn here to go a little bit deeper. You know, it's $197. It's probably just going to be a small handful of 10 to 15 people. And then we have a live breakthrough event. This is a whole different type of event. This is one of it's dearest to my heart in what we build. This is about building community, building impact. It's a really life-changing event of breaking through limiting beliefs and things like that. And we create a really, really solid, this is the foundation of our community is built at the breakthrough event. And this is why we have people are like, wow, there's a certain energy about your community. It's because of this event right here. Okay, so this is January 8th to the 10th. It's in Las Vegas. We already booked our room, so we do have a certain size limit, and we do expect somewhere around 100 to 150 people to be at this event. So that's you. And I say this often, and it's not even exaggerating at all. People leave these rooms being closer to some of the people that are in this room than their family. You know, and it just teaches you how fast we can move and how we can be in relationship with each other. So today on this call here, we're just going to do, you know, these are separate. It is, you know, a $700 thing. And together on this call, just because we hung out together, and you are now a little more clear, and hopefully we can do some business together as well. But you can scan this QR code and come to our live event. And as a gift on top of that, I'm going to give you our recording that investor education series, foundations of commercial real estate with 20 plus worksheets. We're giving all of that for free. We were selling this for $2,500. We were selling it for $1,000 for a super discount now just for end of the year and the beginning of the year, starting 2026, really, really strong. We want to build community and to create a lot of collaborations. We want to give everybody the tools to really be successful in the next 24 months. All right, so yeah, here is the QR code if you want to scan it from your computer to be a part of this. Yeah, really, really inexpensive investment. And this is at least 100x the value that you'll get just by being at the breakthrough event. So yeah.
I think it's perfect timing too.
Yeah, it's really, really great timing. It's great timing. Like if you think about who am I going to partner with? Where do I get the money? Where do I get the experience? Where do I get, the time? You need to find partners. And the way that you find partners is really important. And through our community, this is what we offer is epic people. Okay, let's see here.
I think Lydia had one question and she had her hand up there.
Oh, great. Sorry, I missed that. Lydia? Hannah. Is it Hannah? Lydia? Joanna?
Yes, Alex, I'm so sorry. Yes, it's me.
Don't be
Hey,
sorry.
Alex, my 508-846 number got hacked. I have another WhatsApp number.
Oh.
How do I get onto the WhatsApp mastermind group?
Well, you can be. So here is the. Let me go back up to the top. Is the link to our group? Is you can scan this QR code.
Okay.
So let me see if I can actually put it in here.
And do you think you can share these slides in the WhatsApp chat like tomorrow or so after I join? Or if this is private, I understand.
No, it's fine. I can share it with you guys. No big deal.
Thank you.
This is not a secret. I want everyone to have access to this. So I'll also send this recording out to everybody too.
Oh, that would be wonderful.
Yeah. Okay. Well, that concludes our time here together. I hope to see you guys on Monday's call and bring some friends. I hope to see you guys in our live event in Las Vegas. Yeah, we're actually going to go tour some of our properties and our new projects as well. So it'll be really cool. We're going to take 100 people on a field trip in Las Vegas.
Hey, Alex.
Yeah.
What happened to the Georgia apartment complex? Were you guys able to rescue it?
No, we weren't able to rescue that. So some pains over there, but you know, part of our lessons and our learnings, and we're working through some of the things over there.
Okay, thank you.
Yeah. Okay. So like Grant Cardone actually says, he says, when there's blood on the streets, even if it's yours, it's time to buy. So I don't know.
Buy all the time.
Exactly. Some comfort in that, right? Somewhere. I don't know. Okay. Well, much blessings, everyone. Thank you for taking the time to be here with me. And yeah, hope to see you guys in our WhatsApp community as well. Later, y'all.
Thank you, Alex.
Bye, everyone.
Thank you.
Nice talking to you.
Yeah.
Nice, Jeff. Thank you.
See you guys.